let me welcome on board the management of Mphasis. We've got on board with us Nitin Rakesh, the CEO, and Manish Dugar, the CFO. Nitin, hi, afternoon. If I could begin the conversation with you. Despite Silverline acquisition, your top line growth has been weak and the decline continues. When do you see a recovery coming in?
Yeah, I think keeping in mind that there was a lot of seasonality impact in play, and of course, we've seen the impact of that play out across the industry. I think if you take that issue out, I think we've seen pretty good stability in revenue top line, of course, on an organic basis. We do believe we have visibility to revenue growth in the current quarter. And I think as we get into FY25, we'll probably have a better idea of how the client budgets are panning out. But at this point in time, I think we called for bottoming of performance in terms of revenue last quarter, and that theme continues to play out. And stability in revenue line was visible all through Q3, with a view that Q4 should be a growth quarter for us.
Right. Manish, you have been working on diversifying the revenue stream as well. Talk to us about the progress made on that front and how exactly are other businesses performing this quarter as well.
If you look at the last 4 years, right, we have had significant strategic change in direction from the constitution of revenue perspective. While we are very excited and happy with our performance in BFS, and that continues to be our growth driver, that is where we got all our referenceable customers, and all those customers continue to deliver significant growth and momentum. We have also been able to, using NCA channels and through acquisition of new logos, been able to invest and grow other verticals as well. And we have now 4 verticals outside of BFS, which are already scaled to more than $100 million annual run rate, excluding the DXC revenues. And as we look at the revenues from top 10, 11 to 20, and 21 to 30, we continue to see scale and growth both in the top 10 and in the 11 to 20 and the 21 to 30 on a YOY basis, and on a consistently able to gain more wallet share and become more closer to the customers from a strategic perspective. I think if you look at geography, if you look at vertical, if you look at clients, and if you look at services, whether it is AI, whether it is new gen, whether it is PPS apps or ITO, across all, we are becoming more and more relevant to our clients, and we are happy with our performance till date in terms of being able to strategically diversify the revenue. As we look forward and as we invest in whether it is capability, whether it is geography, whether it is leadership, we are now putting building blocks to make sure that this momentum continues.
Nitin, the deal wins also have been a problem. For last 2 quarters, we have seen a number of sub $300 million. Has there been a bit of a leakage and Q4 will be better, or this is the run rate we should expect going forward?
Yeah, I think keeping in mind that large deals by definition are lumpy, I think the right thing to do is to take a trailing 12-month view or a YTD view for 3 quarters. And I think on that front, we had a pretty big Q1 in terms of deal wins, a record quarter for us. We are still very focused on rebuilding the pipeline. I think on a YY basis, our pipeline is up 12% despite that big conversion we did in Q1. And I think the focus right now is to continue to focus on converting that TCV to revenue while we've continued to build the pipeline. And I think we're still pretty pleased that we had 4 large deals in Q3 as well. And we'll continue to focus on converting the existing pipe to TCV also. So I think not too disturbed by the swings in the TCV number driven by large deals, but very focused on making sure that we are able to convert already one TCV into revenue, and of course, move deals through the pipe into closure stage as well.
Right. Manish, your EBIT margin was also a little soft. What were the factors at play and what's the trajectory expected going forward?
Actually, if you look at it, we expanded the margins to 16%, and we are pretty happy with our ability to work on the operating levers and deliver to our guided northward bias to margins as we had spoken in the previous quarters. This 16% margin that I'm talking about is after adjustment of the 1.1% charge that we took for Silverline, which we had guided as well. And if you look at it, this was a quarter where we had a furlough, and we had a quarter, where we were also facing the seasonality impact. Despite that, an expansion in margin actually is a I would say welcome performance. As we look forward, while we will give a guidance for what to expect as a range of margin for the next year when we do the quarter four earnings, but for the quarter four perspective, we are maintaining the guidance range, which is 15.25 to 16.25, obviously excluding the impact of acquisition. And as we go forward, we continue to have operating leverage that will keep helping us having a northward bias in the margin. However, our stance on revenues will remain forward-leaning, and as we have philosophically commented earlier, we will continue to invest in growth and try and ensure that the margin remains in a stable range.
Right. All right, guys. Thank you very much for joining us, and good luck on deals front as well for the coming quarters.